Hi everybody, this is Ellman, the blue collar investor, with today's option selling question of the day. Today's question comes from Charles. Alan, I bought 100 shares of the ETF XOP and sold one covered call position for May, and it's going to split 1-for-4 on March 30th. What is the procedure for this position? Thanks, and it's signed Charles. Okay, well, reverse stock splits go under the category from an options perspective of contract adjustments. So let's talk about now what these contract adjustments are. And generally speaking, they're corporate events that change the standard options contract to an adjusted options contract. Now, some typical events that may cause an options contract to change include a stock split, merger, acquisition, a special one-time dividend, spin-offs, and reverse splits, which is what Charles is asking about in the email. So let's focus now like a laser on reverse stock splits, which are just one of the possible contract adjustments. This is where there's a reduction in the number of shares outstanding. But there's an increase in share price. And both of those events occur by the same factor. So let's say an option strike price will actually increase when a reverse split takes place because the price of the underlying security will go up and therefore the strike price must go up also. Let's say for a moment we own 100 shares of stock at $5 a share. And let's say there's a 1-for-2 reverse stock split. Well, if that's the case, instead of owning 100 shares, you will now own 50 shares. But instead of the price of the underlying being $5, it is now $10. So if you took a look at your actual total position, in the first case, prior to the reverse split, you have 100 times 5, or 500. And in the second case, you have 50 times 10, the very same 500. So the value of your position does not change when there's a reverse stock split. Now, why do corporations do these reverse stock splits? Just think about it for a moment. Nothing changes in terms of the value of your position, so why bother? Well, the answer lies in the fact that if there's a company whose share price is declining dramatically, at a certain point, that's going to look like a cheap stock, which for some may be a plus, but for a lot of people, it may imply a low quality stock. And corporations aren't happy with that. So what they'll do is a reverse split, increasing the value of the share price, but behind the scenes also decreasing the number of shares. So it's a cosmetic change. Doesn't do anything in terms of the value of the position, just makes it look better. Now, another reason is that certain of the major stock exchanges have a threshold requirement to be listed on that exchange. Let's say it might be $5 per share. So if the price of a company is declining substantially, it may get to the point where the company is worried about getting delisted from a major exchange. And that just is not a good look. So to nip it in the bud, a corporation may vote to have a reverse split, bringing the price of the stock up and moving it away from that threshold that that exchange has. So let's now take a close look at the particular security that Charles asked about, XOP, which is called the Spider S&P Oil and Gas Exploration and Production ETF. I think we'll call it XOP. Okay, so here's a chart of XOP, a one-year chart, and you could see that the arrows on the left side, the green arrows, are showing a bearish signal in that the 100-day exponential moving average is higher than the 20-day exponential moving averages. Now, when we're looking at moving averages, we always want the more recent prices to be higher, and that was not the case, even way back on the left side of this chart. Now, as you're going left to right on the chart, you could see that the purple arrow shows a huge price decline. And that's when there was a price war with Russia and Saudi Arabia, and also the demand for oil had gone very low, and so it was impacting the share price of a lot of these oil-related companies, XOP, of course, included. So the price of the stock started declining from from the 30s and higher down to $8 a share, and that's when this corporate event took place, when the stock was trading at $8 a share. And you can see from the prices on the right side of the screenshot that it quadrupled to 30 and then higher. So you could see just from the technical chart one of the reasons why the corporate board decided to move forward and get approval from its investors to do this reverse split, because they were getting close down to the delisting area, and also the quality of the company may have been questioned because share price was so low. So when the price changes like that and the number of shares changes, what if you owned a contract, an options contract, prior to the reverse split? Well, it's just not fair if you had a strike price of $8 and now the price of the stock is $32. It might be too good, or it might be terrible. So the Options Clearing Corporation has to make everybody whole. So they will determine the best way to adjust these contracts to make both buyers and sellers of puts and calls whole. So their situation will not change because of that corporate event. Now, if you go to the OCC website, you're going to see information like you see on the screenshot now in front of you. And highlighted on this particular site shows that the actual ticker symbol of the underlying will change. That will signify that there was some kind of a corporate event that did change the status of that particular contract. You will see the 1-for-4 split. It will define it as a 1-for-4 reverse stock split. So the price goes up, the number of shares goes down. And it will also show that you could see in the middle of the screenshot the ticker symbol change. And you will see also that the deliverable, the second highlighted area from the bottom, the deliverable will change. In this particular case, instead of 100 shares deliverable, it'll be 25 shares deliverable. Now, here's the thing about contract adjustments. There is no one formula that I can give you that will tell you every time there's a contract adjustment, this is how it's going to work, because they're all done on a case-by-case basis by the OCC. So when you see something on an option chain that doesn't look right, a weird-looking strike price, a weird-looking ticker symbol, something looks out of place, or duplicate tickers for the same strike price, then that's a result of a corporate event. So you go to the OCC site, you put the ticker symbol in, and you will end up with a screenshot like you see right here, which will explain how that particular contract was adjusted and what it means to you. Now, if you still can't figure it out, then my suggestion would be to call up your broker. Even an online discount broker will have a rep that you could speak to, and they won't know this offhand, but they'll look it up for you, and then they will tell you what happened. Hey, yes, it was a 1-for-4 reverse split, 25 shares deliverable instead of 100. Don't worry, you're in the same situation you were in before. Now, if you are looking at a particular stock and you see that the reverse split hasn't happened yet, and but the current tickers are going to be changing, I would just avoid it. You know, there's so many choices. I would just avoid it and move on to another security. Eventually, it'll catch up, and the new contracts will be based on the new pricing. All right, so what are the takeaways from that last screenshot? Well, we know that the share price quadrupled. So it went from about $8 to $32. The number of contracts and shares owned is quartered. So the price and the number of contracts are changed by the same factor. One is increased by that factor and one is decreased by that factor. Ticker symbols will change, reflecting the fact that there was a corporate event. Now, if we owned 100 shares at $8, right, and if there's a 1-for-4 reverse split, in essence, we would own 25 shares at $32. Both of them come to $800. Once again, it's just a cosmetic change, nothing more. So let's just review here. Reverse splits are a sign of weakness of an underlying stock. They're generally not good companies to consider for covered call writing or selling cash secure puts. We prefer much stronger companies with much stronger technical charts. And so generally speaking, we want to avoid any company that's about to have a reverse stock split. But not to worry, contract adjustments will make buyers and sellers of options whole. So there's no free lunch, nobody will get a windfall, and nobody will be hit hard. Everybody will be made whole. That's the job of the Options Clearing Corporation. Now, I mentioned they're not good candidates for option selling, so generally speaking, these companies are to be avoided. Now, the website where you can get information on contract adjustments is theocc.com. Now, there'll be a search area there on the top right. Just put in the ticker symbol of the company that you're looking for and search for it, and the information will come up. It's a very, very reliable site. And finally, before I go, I just want to remind all of our premium members that the entire library of Ask Alan videos is located on your member site. It's the only place that has the entire library. This is Ask Alan video number 176. And so just go onto the site as you see in the screenshot there. Scroll down on the left side to where it says Ask Alan. The arrow's pointing to that on the left side. You'll see the first 10, and then the link under that will say, click here for more Ask Alan, and then the other 176 will appear. For our premium members, we add one new Ask Alan video every month. Well, Charles, reverse stock splits, they come up, that question does come up from time to time. It hasn't come up in quite a while, so I really appreciate the fact that you did send me this email, so thank you very, very much for that. And of course, I always want to thank the entire BCI community for taking the time to tune in to one of my Ask Alan videos. I hope you enjoyed it, and most importantly, I hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.